Welcome to our Q2 update in the office investment market. Over the first half of 2014, office markets have been very active. Indeed, if you look globally, Australia ranks as the 6th most active investment market by transactional volumes. The two key themes that we've seen in Q2 are: one, significant premiums being paid above recent book valuations for transactions, and number two, IRR expectations moving down to and below 8%. The trend is not solely applicable for prime grade assets. In Melbourne, we saw IOF dispose of 628 Burke Street at a 12% premium to their last book valuation. The trend was not solely applicable to core assets, but also B-grade assets in a good location with a solid leasing profile. In Q2, we saw the transaction of 628 Burke Street at a 12% premium to its last book valuation. As a result, JLL has recorded yield compression across eastern seaboard office markets. Pricing at the tighter end in Sydney has moved below 6% for the first time since 2008, and also at the tighter end of the yield range, we're recording 6.25% in Brisbane, again for the first time since 2008. Multiple buyer cohorts are active in the market, whether that be A-REITs, domestic wholesale funds, or offshore investors. Offshore investors continue to oversubscribe to the Australian market. Looking over the past 18 months, Sydney ranks as the 4th largest recipient of cross-border investment flows, and Melbourne also ranks in the top 10. The gateway cities of Sydney and Melbourne continue to be benchmarked globally. Over the past 18 months, Sydney has ranked as the 4th largest city of cross-border investment across the world, and Melbourne also ranks in the top 10. Through 2014, we've seen significant yield compression in New York, London, Paris, and Tokyo. Historically, the spread between New York and Sydney has been 110 basis points. The spread reflects the difference in the real risk-free rate and also the application of a liquidity risk premium to Sydney. At the moment, we see the spread at 240 basis points, implying that prime grade assets in both Sydney and Melbourne and the other Australian CBD office markets look good value on a global context. Earlier in the year, we made a prediction that transaction volumes would be lower in 2014 and 2013. Given the activity that we've seen over the first 6 months of the year and the expectation of a number of large assets being brought to market in the second half of the year, we may have to revise that expectation. Attention has been turned to the leasing markets. Sydney and Melbourne are the beneficiaries of an economy that's transitioning from mining sector-led investment to more domestic drivers. Over the past 12 months, we've recorded positive net absorption in both Sydney and Melbourne. Furthermore, new sources of demand are emerging from the technology and technology-related sectors. We don't expect to see a Lazarus-like recovery in tenant demand over the short to medium term. However, a moderate recovery in tenant demand does provide an additional ingredient to the investment thesis for assets with shorter lease terms. I hope you've enjoyed this update of Office Investment Review. If you do require any further information on the investment market, please don't hesitate to contact us.